Guys, with people having their funds locked in crypto exchanges like FTX and other cryptos and exchanges, a lot of people are worried about how safe their funds are. And many people are now worried about contagion in the financial system. What if this spreads into banks and brokerages, either from the crypto problems or just from the financial system collapsing like it almost did in 2008? Wasn't your money supposed to be protected in FTX? Is your money safe in banks and brokerage accounts? Do they have the same legal protection, or is it even worse? Also, I will explain what the FDIC Insurance and SIPC Insurance is and what they protect and what they don't. And lastly, I'll tell you what you can do to protect yourself. So let's start with the protection stated in the terms of service at FTX. So FTX's terms of service were actually very good if they actually stuck to the terms of service. So here it says, you control the digital assets held in your account. Title to your digital assets shall at all times remain with you and shall not transfer to FTX Trading. None of the digital assets in your account are the property of or shall or may be loaned to FTX Trading. FTX Trading does not represent or treat digital assets in users' accounts as belonging to FTX Trading. Sounds great, right? But Carolyn Ellison at Alameda said on a video call Wednesday that FTX had sent customer funds to Alameda, according to the Wall Street Journal. And SBF told the Financial Times that FTX had accidentally sent $8 billion to Alameda. So the terms at FTX are that they are just a custodian of your assets and they cannot loan them out to anyone. A very good analogy to use is a parking garage. A parking garage is a business that holds your asset until you ask for it back. If the parking company goes bankrupt, your car is not used to satisfy the debt of the company. This is what the terms of service were at FTX. But instead of parking your car like a parking garage, they instead took your car, rented your car out to Uber drivers who then took your car, drove it around and put wear and tear on it, and then crashed it and totaled it. And when you came back to the garage to ask for your car, they say, we have no idea where your car is. Make no mistake, this is illegal and SBF should be in jail. Now, you might be surprised to know that the terms of service for banks are actually worse than that of FTX. You see, banks used to be just like a parking garage that holds your car and has no claim on it. Well, this was before the great financial crisis. And what came out of that crisis is the Dodd-Frank law that now makes bail-ins legal. So what is the difference between a bail-in and a bailout? Well, a bailout is when the bank becomes insolvent and gets a cash infusion from the government with taxpayer money. A bail-in is when a bank becomes insolvent and is allowed to take depositors' money to pay off the bank's creditors. So this is like parking your car in a parking garage where the parking company takes ownership of your car and makes you an unsecured creditor to the parking company. So whether you drive a $10,000 Honda Civic or a $300,000 Rolls Royce, you are an unsecured creditor to the parking company as if you lent them your car. And unsecured creditors like depositors and bondholders are behind derivative claims for paybacks. So if a bank blows itself up with risky derivative bets, they will use your deposits to make sure the hedge fund or investment bank on the other side of their trade gets their money first. Nice, right? Thanks, Barney. So where does FDIC insurance come into all of this? Well, FDIC insurance covers your bank account up to $250,000 per account. Bail-ins would take money above that $250,000 amount to pay creditors. Since 1980, the FDIC limit was $100,000 per bank account. But During the great financial crisis, bank runs started. And although they weren't reported in the news because they didn't want to make it worse, I know people that tried to move money out of their large bank and were questioned and persuaded by the managers not to do it. They really started to get desperate when people realized the banks were insolvent because of the underwater mortgages they held on their books. And they even suspended mark to market accounting of those mortgages so banks did not have to admit that they were insolvent. Anyway, the $100,000 limit was temporarily moved up to $250,000 in 2008 to stop the bank run risk. And eventually that $250,000 limit was made permanent in 2010. Now, if you think something like this won't happen again, well, it already has. In 2013, Cyprus did a bail-in and took 47.5% of all deposits above 100,000 euros. Also, in 2013, Poland confiscated private pensions of their treasury holdings so that they didn't have to raise their debt limit on spending. And one more thing to think about. Most banks that go bankrupt are small, with not a lot of depositor money in them. What would happen if one or a few big banks failed? Is there enough money in the FDIC fund to cover depositors? Well, just know that there is about $18 trillion in bank deposits, and the reserve ratio is about 1.35%. That means there is $1.35 in insurance for every $100 in deposits. But that's how most insurance works. An insurance company may only be able to pay out 1% of the home fire insurance policies they have because it is unlikely that many homes will burn down all at the same time. This may or may not be the case for banks. So what can you do to reduce your risk in banks? Well, even if you have less than $250,000 in your bank, you should have multiple bank accounts because if your bank goes bankrupt in the next financial crash, you may be waiting a long time to get your FDIC insurance money back. So, what about brokerage accounts? Well, they have a client protection rule which keeps customers' cash and assets separate from the brokerage assets. So, brokerage accounts are like a regular parking garage that just holds your car and does not make you an unsecured creditor to them. But if you sign a margin agreement for a margin account, you probably already agreed to let them lend out your stock holdings. So, do they have an FDIC-like insurance? Well, yes and no. They have insurance, but it is not government insurance. It is SIPC, Securities Investor Protection Corp Insurance. This is a nonprofit industry membership organization. It was created in 1970 by the SEC Investors Protection Act, and the SIPC insurance covers up to $500,000 in securities and cash in your account, with the cash coverage not more than $250,000. So it would cover $500,000 in stocks or $250,000 in stocks and $250,000 in cash. Now, the SIPC insurance only covers cash and securities, and so things like warrants, commodities, and futures are not considered securities, so they are not covered. Now, most brokerages tout the extra insurance that they have above the SIPC limits, but if you read the fine print, it is the total amount of insurance for all customers, not each customer. So they might say, we have insurance of $50 million above SIPC limits. That just means the first $50 million hit customer accounts take is covered. Anything over that is not. Now, most brokerages have hundreds of billions, if not trillions of dollars in accounts, so $50 million is kind of a drop in the bucket. It's more just kind of a marketing thing, I think. And if I didn't scare you enough yet, we're now going to get to the part that you don't really own the stocks in your brokerage account. You see, they are held by the brokerage for you in something called street name. So something like owned by Fidelity on behalf of Joe Schmo. And even then, Fidelity doesn't really own it either because they have an account with Cede and Company that actually owns all the stocks in the US. So Cede is supposed to be short for certificate of deposit, but the definition is actually to give up power, yield, or to relinquish. Nice, right? So, what can you do to protect yourself in brokerage companies? Well, it's kind of the same as with banks. Hold multiple accounts, and I would say at least 3, especially if you have an IRA or 401k also. And what can you do about Cede and Company owning your stock? Nothing. Just know that the day they confiscate your stock is the day there is no more stocks and stock markets for anybody. There is only so much you can do to reasonably protect yourself against a financial crisis in the future, but it is better to take steps now while things are relatively calm than wait for an emergency where you have to scramble to get access to some accounts or to some money. This video is not made to scare you. It's made to let you know the risks of your accounts and to help you take steps to reduce potential problems when things get crazy. It's not meant to scare you out of banks or brokerages. Now, as for cryptos and crypto exchanges, you're on your own with that. Good luck.
All right, dorks, this is a hold-up. Oh, yes. Download to Papa. Yoink.audio/losers.